Thank you, Paul, for a very kind introduction, and thank you to the organizers of the event for inviting me here today. It is really an honor to speak to all of you this morning. I am from the U.S., but I am not a lawyer, so I'm one of the few who escaped. I have to say that that SME businessmen and businesswomen are the core of every country's economy, and I appreciate the risks and the challenges that each of you face on a daily basis. In the short time that I have been in Dubai, I have come to realize that entrepreneurial spirit really characterizes this great city that we have the fortune to work in. So you may therefore wonder why a regulator has been invited to speak to you today. After all, isn't regulation just about business prevention? Well, I hope that over the next few minutes I'll be able to convince you otherwise. I also hope over the next few minutes that I'll be able to convince you that I've gotten some things done. Let me start by telling you a little bit more about the DIFC, the Dubai International Financial Center, and the DFSA, the Dubai Financial Services Authority, where I work. Even though these are government bodies, I do believe they represent some entrepreneurial spirit, and I can tell you that we focus directly on best practice on a daily basis. Since its inception only 12 years ago, the DIFC now hosts more than 1,400 businesses and more than 20,000 employees. As the sole regulatory body in the center, the DFSA now supervises 500 of these entities, including 413 financial firms, 113 non-financial businesses, 16 registered auditors, and 2 market institutions. We've also developed local regulatory talent through a program called Tomorrow's Regulatory Leaders. We have actively reached out to the wider UAE local community, starting with local institutions of higher learning and continuing through financial literacy and awareness program under the title of Bawabati. We are very proud of both of these programs as contributors to Dubai's knowledge economy. Now, the challenges that face each of us today are many, and those many are increasingly complex. Throughout 2015, we've seen interest rates in the U.S. rise for the first time in almost a decade. We've seen China's GDP beginning to slow. We have seen Europe's GDP struggling to rise. We've seen energy and general commodity prices fall further and faster than anyone predicted only a short time ago. We have seen escalation of political instability and conflict in certain regions, and we have seen the painful struggles of refugees as they migrate away from war-torn areas of the country toward visions of a better life. Being a crossroads for global trade and finance, as well as having a few challenging neighbors, each of these items has occupied our minds at the DFSA. We continue to be faced with a number of these complexities and uncertainties in 2016 as well. Many economists expect interest rates to continue to rise in the U.S., although by how much and how fast is a long debate, which is dependent on how the U.S. economy grows and how it reacts to situations around the world. Many expect oil prices to rise slightly in 2016, but the range of estimates has many externalities in play. China does not expect a V-shaped economic growth in 2016, but should continue to grow at a stable pace. Many countries would be pleased to have China's rate of growth even at its slower pace. And Europe is showing some positive signs of their quantitative easing program, although probably not as rapid as they wished. So what is the role of a regulator in this mix? Focusing on today's themes, how will regulation help each of you? First, let's look at a few of the issues. We often hear that government is in the way of business and governments should step aside. That is not completely true, but it can be. We also hear that government must guarantee its regulations ensure all customers have available cheap credit. That's also not completely true, but it can be. Achieving the right balance between allowing entrepreneurial spirit and protecting customers is not always easy to achieve, and we often pass the equilibrium on our way to the outer edges of this pendulum. A financial services regulator has 3 main areas of focus. We must maintain confidence in the system and contribute to the stability of the financial system. This is where you see minimum amounts of capital, liquidity, and transparency in financial sector rules. We are not trying to eliminate risk-taking, but to strongly encourage risk management. We must secure an appropriate degree of protection for consumers of financial products. This is where you see proper disclosure regulations and regulations around suitability of products. We also must reduce to the extent to which the financial system is used by criminals. This is where you see know your customer rules on how to open and maintain bank accounts. Each of these areas has received attention in various post-crisis reform agendas. Naturally, what sits behind all of these objectives is good corporate governance and proper culture. The DFSA has a strategic business plan that reaches across all of these objectives to achieve compliance with international standard setters for financial regulation and address the needs of our financial center. In order to build credibility on a global stage, the DFSA takes a very active role with those global standard setters. As I know many of you are involved in trade, I can tell you that compliance with global standards is critically important to trade finance and trade documentation if you want your products to cross an international border. Another element that sits behind these areas of focus is proper stakeholder communication. The DFSA puts a large amount of effort into communicating with the industry we regulate, and this pays dividends both in terms of better compliance and enabling business. Regulators often make the mistake of thinking everyone understands their rules, but industry also makes a mistake of thinking that asking a question of a regulator is a bad idea. We have to talk together. So where should we be looking next? Do all of our post-crisis regulatory reforms mean that we would be better able to withstand the previous crisis? The answer to that is probably yes. Does this mean that we're better able to withstand the next crisis? The answer to that is unknown. Just like the previous crisis and the crisis before that, the next crisis will likely come from a place we are not now looking. And I'd like to turn to a few examples to spur some discussion in this area for you later today. Mostly by virtue of new technological advances, a number of disruptive forces have entered the financial marketplace. Many of these disruptive forces are captured under the heading of FinTech, including cryptocurrencies like Bitcoin, crowdfunding, mobile banking services, and internet payment services. All of these FinTech concepts are providing traditional banking services, but outside of a bank, and often outside of government regulation and supervision. It is becoming increasingly evident that technology is driving wider financial inclusion, and that's a good thing. But to preserve financial stability and ensure fair treatment of customers without killing the technology movement is the challenge that faces regulators today. The DFSA is currently considering the activity of crowdfunding, and this work may result in future changes to our regime. If we intend to change, we will naturally publicize our views through a consultative paper and engage with the industry as part of our normal communication program. While I think financial institutions are more resilient and less likely to fail than they were 10 years ago, I'm not sure that consumers are better educated about risks in the financial products, nor do I feel confident that consumers are better served by the industry. Conduct of business risks, fair treatment of consumers, and financial literacy should be paramount consideration for governments, not just a side note. Financial literacy is an essential everyday life skill, even more so in today's environment. As regulators, we can certainly continue to punish institutions for misleading ill-informed consumers or offering them the products that are not suitable. But governments must also consider a duty to arm those consumers with enough knowledge to prevent those abuses in the first place. I realize that not every regulator is comfortable with that role, and regulators might not be the best place to initiate a financial literacy program, but this must be addressed. Another area of concern is the overall concept of de-risking. SMEs like yourself and remittance traffic around the globe have been damaged in this process. The Middle East region has a particularly large volume of migrant workers that are affected by this issue. While there are legitimate concerns for the financial industry surrounding money laundering and terrorist financing risks associated with correspondent banking, wholesale disconnections of entire countries from remittance traffic is an unintended consequence. So in closing, I'll emphasize just a few points. While financial institutions and their regulators might only be able to act locally, they must think globally in today's economic environment. Compliance with global standard setter requirements is not always easy, but it must be done. This is particularly important to cross-border trade and trade finance. And finally, good governance, active communication with stakeholders, and transparency bring better compliance to the industry and better business for all of you. Thank you very much.